Well, as BSE celebrates its 150 years of legacy and leadership in India, and that is the day to mark definitely. So let's connect with two of our experts and guests, special guests on the show, which have seen such a great journey of the index of the Indian stock markets and are here with us to share their knowledge. And let me welcome Mr. Hemendra M, Kothari, who is the chairman of DSP Asset Managers, as well as Mr. Keki Mistry, who is the former VC and CEO of HDFC and independent director in several companies, is joining us on the show right now. Hi, very good morning, gentlemen, and it's a pleasure speaking with you. But Keki, sir, I want to come to you first. Definitely, BSE is seen to be celebrating its 150 years of resilience. But you too have been in this industry for decades now. How have you sailed through the highs and the lows of this highly volatile journey?
It's been volatile, but it's not been as volatile as equity markets can otherwise be. And I think the way you have to look at it, at least the way I look at it as an investor, is when you invest in a stock or you invest in a mutual fund, it has to be a long-term investment. If I invest in a stock today, I don't keep looking at the stock price every 2 months or 3 months or 6 months. I don't look at it at all. Once invested, I stay invested unless there is a very specific reason why something has happened which makes me want to get out of that stock or get out of that mutual fund. Otherwise, equity investment is a long-term strategy. It cannot be a short-term strategy. And I don't buy the theory that you buy on dips and sell when the markets are high. In my opinion, that's not the way to invest in equity.
Mr. Kothari, the landscape itself has changed altogether. Now, from physical shares to now shares in the demat form is what we are seeing. And sources of information too have evolved with emergence of the media and technologies. Now, news flow decimates in a fraction of the second. How have this evolved? Help us share your views on this, and which sources do you resort to back then to invest in the equities?
In 1991-92, it started that we will go our computerization of the stock exchange. That was the year when Wipro was the one who gave us the mainframe computer, and online trading started after that. So that was the year, roughly, my memory says. And so from there onwards, of course, it has evolved today into much more, where anybody can sit anywhere. It started also in late 70s, where brokers started dispersing into the other offices and could do online business.
Keki sir, since you have tracked the banking and the financial services industries very, very closely for several decades now, help us understand how has the banking system evolved over the years from when you entered the sector to now, and especially with the pace at which the digitization is taking over, how has the transition been?
Well, first of all, the banking system or the entire financial sector in India is so very, very, very underpenetrated that for the next 5, 10, 15, 20, 30 years, I see a lot of growth in the sector. Any financial product you look at, the penetration levels in India are extremely low. So if I look at investing again, I would buy a banking index or I would buy a particular stock of a bank, and then I would stay invested in that stock or stay invested in that mutual fund for umpteen number of years. I would really never look to sell out of a mutual fund where I've invested in a particular mutual fund, particularly a sector-specific mutual fund. See, equity markets will go up and equity markets will go down, but investment, long-term investment is what will bring you value. Short-term investment traditionally will never bring you a long-term return.
And Mr. Kothari, we see that the equity cult seems to be seeping in, and now SIP cult seem to be taking over. Do you believe India's domestic inflow will continue to lead India's equity market higher?
It started in 1985, was the first time I was instrumental in bringing foreign institutional investors along with Merrill Lynch. We had a tie-up for business. where we brought investors and took them around from Delhi, Pune, Bombay. And in '86, we launched a country fund where we thought UTI is the right ideal partner to have as a fund manager. So that's how '86 first country fund was formed and listed in London Stock Exchange. It was a closed-ended fund, and then, of course, various funds came up. '87, it was in US, and then '91 when India opened up. Then '93, '94, GDR and ADR issue started. So that was the way. Initially, a lot of trading used to take place in ADR and GDR, but Indian market today is so active that nobody thinks of going for ADR and GDR, but business is taking place in India itself. And that is very, I would say, a great change, a great welcome change which has happened.
Good morning, Mr. Mistry. This is Cheryl also joining in the conversation. And if you talk about the banking sector, that one is a very evolving one, isn't it? But any loopholes that you are seeing in the sector and the sector needs to actually work on in order to improve and thereby improving the way it actually functions?
No, I think it's a very evolving structure. In fact, the entire IT framework, the entire digital framework, the entire the scope of that artificial intelligence is going to bring into every single business, whether it is banking, whether it's financial services, or whether it's anything else. It is so huge that every company, every bank, every finance company is tracking what is going on in the external environment and therefore trying to keep pace with what is happening. So I don't think there is any flaws or any loopholes anywhere. We have the most thoroughly well-regulated financial sector in India, whether it is from RBI, whether it's from SEBI, whether it's from IRDA. So very well-regulated. If you look at NBFCs and banks, they are currently having the lowest level of non-performing loans that you would have seen for very, very, very large number of years. So at this point of time, everything looks very attractive from a financial service standpoint.
Right. Good morning, Mr. Kothari. This is Cheryl also joining in the conversation. And equity markets have been actually very volatile of late. And this led to what is exactly happening geopolitically, especially when you talk about the tariff wars as well. But if you look at India, the macros continue to remain strong. But given this, given the India's positioning and the resilience, are you expecting or are you envisaging the Nifty hitting 40,000 mark in the next 5 years, which implies about 12% CAGR at the index level?
I don't want to speculate, but surely Nifty will go up much higher than today. Normally in 10 years, it is more than doubles. So we hope it grows up that level. India growth is much better in India than compared to other countries. We have to see just now what is happening into the world with tariffs. We have to see the temporary, what the business will be looking like. But I'm very optimistic about the business in India. And I think what we are seeing, 7.5%, 8% growth is very likely, if not more. So India will remain one of the more attractive destinations for the foreign investors and Indian investors.
Keki sir, now shifting focus from the banking to investing then. And any specific asset allocation approach that you follow, and if you can share that knowledge with our viewers as well. And do you invest in commodities, silver or gold, or even equities or fixed income per se?
No, so the way I invest is I would look at about anything between 55 to 65% of my total investments in equity. Equity could be either a direct equity or it could be an equity mutual fund. Then I would look at about 10% of my portfolio being in real assets, which would mean things like real estate or gold bonds or gold ETF or anything of that sort. Or it could even be an alternate product, which is an AIF product. And then the rest of the investment, typically being, let's say, 30-35% approximately, would be in fixed income secured. Maybe less than 35, about 25 to 30% would be in fixed income securities.
Right, Mr. Mistry, let me come to you and let me ask you for your advice for these young investors, especially the investors who in fact started investing just off late in the market, those who actually started investing post the COVID era, because they have expectations of higher returns and have actually never seen such a huge meaningful correction. So what would be your advice for all of those frayed nerves at this point in time?
My advice is what I mentioned earlier, that when you're an equity investor, when you're investing money in equity, do not look at short-term returns. Do not look at markets going up 2% one day and coming down 2% the next day. That's not the way to look at markets. India is fundamentally a growth market. I have no doubt in my mind that the growth story in India is very, very, very strong, and not for 1 or 2 years, but for a very long time frame. And therefore, consistently, you will see that if you take a 5-year view or a 10-year view, equity markets will do very well. But if you take a short-term view, 3 months, 6 months, 12 months, you will get a lot of this volatility. And again, when you think it's a good time, there's nothing like a good time to buy, unless you believe the markets are extremely overheated at a particular point of time. Otherwise, every day is a good day to invest. Because when you're looking at a 10-year investment frame, whether you're buying it today or buying it 1 month later, you may get it 1%, 2% more expensive or cheaper. That is not going to make a material difference in terms of your long-term return. So look at long-term, look at a minimum investment span of minimum 5 years, preferably 10, 15 years, and stay invested.
All right, then we'll leave it there. Thank you so much, Mr. Mistry, as well as Mr. Kothari, for joining us on ET Now to talk about the Indian markets, the way forward for these young investors, and given the fact that you have BSE that is celebrating 150th birthday, an iconic day coming in for all of us stock market investors. But on that note, thank you so much for joining us on ET Now.
If you like this video, then like, share and subscribe to ET Now.